Good morning and happy Tax Tuesday. My name is Heather Ryan. I am the owner of Tax Queen, a business, tax firm business supporting digital nomads, RV entrepreneurs, and other nomadic business owners or just travelers in general. And Tax Tuesday is a time for you all to ask questions and get real answers. And you can submit a question online before Tax Tuesday or while we're live. If I have some time, I'm happy to get to those questions. So let's jump on in since we're at 10 o'clock. I am excited to have a few questions this month. And then anybody who's joining live is welcome to ask questions as well. Usually I'll have time for a few. So let's get started. Question number one, I have an S Corp. My husband works for a big box store and we get healthcare from his employer. He is leaving his company at the end of August in preparation for us going full-time in September, and he'll be starting up his own small business. My S Corp will be picking up our health insurance beginning in September. Question, do we have to consider COBRA from his employer per your statement? You cannot take self-employed. All right. So I recently published an article on my website about taking health insurance as an S Corp owner, and she or he is referencing that. I will share that article with you so that you can take a look if you haven't seen it. But basically, does COBRA count if you are an S Corp owner and going to be paying for your own insurance? So COBRA does not count as self-employed health insurance. So let's step back a second. When you're self-employed, whether that's an S Corp or a sole proprietor, so a Schedule C tax filer, you can qualify for the self-employed health insurance deduction. So as long as your business is revenue positive, you do get to take a deduction for health insurance that you buy for yourself and your family. So it would qualify for your husband and wife, right? And kids. But it has to be either in the name of you, so yourself, right? Or your business, and your business has to pay for it. So in the case of COBRA, the plan is still in the company's name. So it's not tax subsidized or anything of that nature. It's not subsidized by the company anymore on COBRA, but it's still a company plan. So whatever that company is. So if you work for Google and then you leave Google and you buy into their COBRA plan, the health insurance plan is still to Google, not to you individually. So you need to establish a new plan, whether that's through the government exchange or something else that you find, and it has to be in your name, and you can be reimbursed for it, or the company can pay for it directly, but it has to be in your name or the company's name. Typically, if you're just you as an S Corp owner without employees, it would be in your name because they don't have employer plans at that level. You have to have multiple employees in order to qualify for an employer sponsored health plan. Does that make sense? I hope that makes sense. I hope that's clear. So just to reiterate, COBRA does not count for the self-employed health insurance deduction. And I did share the link talking about tax deduction as a self-employed individual, particularly as an S Corp owner, because it's a little tricky. So number two, I'm currently set up as an S Corp based in New Mexico, and the only W-2 employee I have is me. So S Corp owner must have a salary. We all know that, right? I'm getting ready to hire another W-2 employee whose home is in Colorado. I think I can have my payroll processor handle state payroll tax accounts, but I'm curious if I need to do other things like register my business in Colorado and start filing a state income tax return there. No. So if you have an S Corp and you are an employee outside of your state, wherever you're based, so in this case, New Mexico, you do not need to register in that other state just for payroll accounts. So you do need payroll accounts, but you don't need to register a business. You don't have income in that state, anything like that. So yeah, you would only need to register for payroll accounts. So you're talking Colorado. I'll be specific here. Colorado has unemployment insurance, which you would have to sign up for, and your payroll provider should be familiar with that. You would also have to do withholding for that employee. So Colorado withholding for that employee because they owe Colorado state tax. And Colorado has what we call a family, FAMLI, and that is for family medical leave, and that is a new tax. I call it a tax, but a new cost to having employees. So it's 0.9%. Half of that is paid by the employer and half is paid by the employee. So just be aware of that. So in 2023, it's only the 0.45% paid by the employee is collected. And starting in 24, it's going to be both employer and employee for that family part. So you have unemployment insurance, obviously your Social Security and Medicare, which you already are familiar with because you're doing it for your own paycheck, Colorado state withholding tax, and then your family. And that should be enough. So just be aware of that. And you may also file or have a need for workers' compensation since you'll have an employee. So just be also check on those rules and regulations if that's required. Just things to consider. So hopefully that answered that question. Let's go on to number 3. And again, if you're live, feel free to drop a comment or question rather in the comment section, and I might be able to get to you guys. I have a few more questions to get through, but I'm happy to answer some live questions as well. So, third question, I'm curious about the possibility of writing off. I don't like the term writing off, just so you know, it is a deduction. It's not a write-off, it's a deduction. Don't think of it as just, oh, I'm going to buy this because I get to write it off. I don't like that, using that term. So technical term is taking a tax deduction. So taking a vehicle purchase, if you use the vehicle to generate informational content specifically about that vehicle. For example, we're thinking of doing YouTube and blog articles, including reviews, how-tos about this particular vehicle, not an RV. We would not be able to create this type of content without using the vehicle ourselves and becoming familiar with it. It will be our only primary vehicle, so we would sometimes need to drive it for non-business reasons, but not too often. Is it similar to a laptop expense where we can deduct off the percentage that is used for business purposes? So any vehicle you use that has an engine, a motor, there's 2 ways of taking this deduction. Number 1, you always, and I will repeat this, you always need to track mileage. So mileage is what says this is a business vehicle versus or personal use, right? So business purpose, personal purpose. Mileage is going to dictate that. So no matter where you start, track mileage for that vehicle. So once you have the mileage, that's one way of taking deduction. So the IRS allows you to take the standard mileage deduction. So you just use the rate that they have that year, whatever that is. It changes each year a little bit, by a few cents. You multiply that times how many miles you drove that vehicle for business, and that's your deduction. Really simple, really easy. Doesn't require anything else or records or anything like that. You don't have to get gas. You don't have to, track your insurance, any maintenance, all of that stuff. You don't have to do any of that. So that's one way to do a vehicle. The second way is through taking actual expenses. And actual expenses are things like insurance, repairs, registration, anything of that nature, including the price of the vehicle. So we're going to depreciate that vehicle, and that's required. And you still need mileage, right? So you have mileage. So if you drove that vehicle 10,000 miles in a year, and let's just say 5,000, we're using really even numbers, 5,000 of it was for business purposes. So you have 50% use for business. So now you can take all of those actual expenses that you just been tracking all year long. Remember, you have to track mileage and all of your expenses with receipts. Record keeping is important. And then you can take 50% of that, including 50% for depreciation of the vehicle. So those are the 2 methods. So standard mileage and then actual expenses. If you take actual expenses the first year, you must always, and I'll repeat that, you must always take actual expenses for the life of that vehicle. If you take the standard mileage deduction, you can actually flip into actual expenses in the future years if you want. Typically, I see the standard mileage rate a better deduction, less record keeping, less tracking and all of that. The only thing you're tracking again is mileage. So Keep that in mind. There's always exceptions to that rule. And I do work with my clients when we work on our tax return together, or your tax return. We'll kind of look at both ways if you've tracked all your actual expenses. Many people just choose to track mileage because it's simpler and easier. And you don't have to worry about all that extra stuff. So just be aware of that. Those are the two ways to be able to take off a vehicle. There are special rules and exceptions. If I knew a little more maybe about the exact vehicle, I could give a little more information, but that's the basics. So next question. I may start my own business as an Etsy seller. Very cool. I currently collect Social Security, and my ex-husband sends me half of his pension retirement money as our settlement agreement. Here is my question. As a California resident, will my Social Security and his monthly payment be taxed? Will I claim both payments as income? So that's the same question, really. What are the tax filing requirements for an Etsy seller store? So let's address the first question, and I can't fully give you an answer. If his half of pension and retirement money, part of the settlement agreement, is considered alimony, alimony can be taxable income to the receiver. So this rule changed in 2019. So depending on the divorce date and what the paperwork says, if that's claiming alimony payments to you, then it is taxable. It could be taxable. So just be aware of that. And Social Security is also taxable. Both of those are taxable income. Doesn't matter if you're a California resident, if you're a Ohio resident or New York resident, those are taxable income to everyone. Again, alimony is treated differently depending on when the divorce happened, was finalized, and how that is classified in the documents. So what the divorce decree, if those payments are considered alimony, then you have taxable income. The only payments when you get a divorce that are not taxable will be child support to the receiver. So, and then the tax filing requirements for an Etsy store seller. So an Etsy store seller is a business owner. So it's a Schedule C as part of your business, or as part of your personal returns, a part of your 1040. File Schedule C, and that reports all of the income you earned and all the expenses you had for the business. So that's the tax filing requirement of any business owner, including an Etsy store seller. Just making sure to track all of your expenses and all of the income that comes in through Etsy. So it does get a little complicated if it's a new thing to you being a business owner, but the minute you start an Etsy store, you are a business owner if you earn more than $600. Or I'm sorry, it's actually $400. If you have more than $400 of self-employment income, you have a business, net profits. So just be aware of that. And $600 is the 1099 filing requirement. That's why I was coming up with that. So I hope that answers those questions. If you have more, feel free to drop a line or maybe clarify a little bit. That's fine. So question number 5, I'm looking to purchase a new RV this fall. I'd like to know if there are any updates, information you've already written about the following topics. Deductions for interest if the RV is my primary residence. Nothing's changed there that I am aware of. So just to reiterate, if you're not familiar, if your RV is your primary residence, any interest on the loan that you're paying would count as a mortgage, kind of. Most likely you won't be able to deduct this because I don't see too many people actually itemizing. So in order to take loan interest, including mortgage, which the RV would then qualify for, you have to be able to itemize deductions. And it's a rare case that that's happening nowadays because that standard deduction is so high. So just be aware of that. And then the second one, what about tax credits for solar installation? Solar install has not changed since I have written about it. I believe I have updated my article. So let's just share that solar article. So we're at 30% of installation costs, and that is a non-refundable tax credit. And that means it's just going to take down any tax liability that you already have. If you have no tax liability, it's just going to carry forward to the next year. So just be aware of that. I do see that come into play sometimes with retirement income or lower income earners. and you can't actually take the credit anywhere because there's no tax liability to take it against. So just be aware. What's the third one here? Advantageous way to lower your sales tax on the purchase of the RV. I hear about people establishing an LLC in Montana. I personally do not recommend having an LLC in Montana. Many states have caught on to this scheme, and while it is perfectly legal in the state of Montana, many other states do not appreciate it, and if they catch you, they will they can get you in trouble, and they want their sales tax. They want you registered in that state of your domicile or your residence. So just be really cautious with that. I do know there are plenty of RVers that do it, and I say get away with it, but it can be risky. If you're not up for taking that risk, then totally makes sense. But yeah, so I don't necessarily do that. That's more of a legal thing, just so you know. And I do know that especially the states out west do not appreciate LLCs and RVs and trailers and things registered in the state of Montana. It's a red flag. So what else? I see a couple of questions, but I have one more that was asked previously to the live version, and then I will get to a couple of those comments or questions in the comments. So just give me a minute. So last question is, I'm considering purchasing a system from Tiny Watts and want to know if I will be eligible for a tax write-off when I file next year. So Tiny Watts is a company that installs solar systems. And so that would kind of go in. I answered this in my last question, and I shared that my article about solar tax credits. So yes, you most likely would qualify. And again, it's at 30% currently. So hopefully that answers all those questions. And then let me take a look, and I saw some people writing some things. So Kelly, sounds like I answered your questions. You were the one who asked about the 3 different ones. Hopefully I was clear about that. Let's see, Margie, I'm self-employed and work remotely, would like to add Starlink. What deductions are allowed for equipment and monthly service? So depends. Internet and phone is kind of a sticky situation when you're full-time. And if you have multiple plans, so you can maybe pay one plan with your business. So otherwise you could just pay half of it, pay half the Starlink or something. That's like 50% would be for your business. That's kind of how it's really up to you. How much are you working? How much are you using it for pleasure? Watching Netflix, doing email, doing research on planning and travels and things like that. So just be aware of that. But yeah, I mean, that's definitely available as a self-employed individual to take deductions for the Starlink, for using Starlink, just like any other, if you have Verizon, a Jetpack or Visible plan or whatever it is that you have to get you online as you travel. So, can a single person consulting business qualify for the $23,000 tax credit? I don't know what that is relating to. So I am not sure what that question is. So a single person, a consulting, what do you mean a $23,000 tax credit? I'm not sure what that means. If you're self-employed, you have to pay self-employment taxes, on that income. But yeah, I don't know what that question is referring to. So if you're on here live, Anthony, please feel free to clarify that. Otherwise, if there aren't other questions, I am going to sign off for the day. I really appreciate you all being here and being a part of Tax Tuesday, and I hope this is helpful for you. Remember, you can always submit your Tax Tuesday questions ahead of time, and I will answer them live. Let me get you that link so that we can do that. And just in case you still have burning questions after we sign off, so here you go. You can share your questions there. Otherwise, I will see you in August. And let me look up at the date because I didn't do that ahead of time. Let's see, August 1st. So August 1st is the Tuesday. So we will see you August 1st for the next Tax Tuesday, 10 a.m. Mountain Standard Time. And otherwise, have a great month of July. Enjoy your summer wherever you happen to be. And I will see you next time.